And this is almost like 2008 playing over again. Now, not in the housing. If you want to look at some sort of similarity for housing, I'd go back to 1978. But for car loans, somehow these car dealerships and car manufacturers, they somehow got their states and the federal government to allow them to give these loans without any sort of um, oversight. And so anybody and their brother, I mean, there was a poll this past week about people who have gotten car loans over the last couple of years, 3 years, and they all almost unanimously said I was able to lie on the application. Right. So anybody can get a car loan. It turns out if you look at the dealer model, dealers are making more money in loans on cars than they are in actually selling cars. The business has kind of changed in the last 5 years so that the dealers want to make loans more than they want to sell cars. And so they've been making these loans up to about 125% of the value of the car, and that's to pay for fees and all of that good stuff. Or and the car values have been very high because, again, of what happened during the pandemic. There weren't chips. There's been a scarcity around automobiles, so all of a sudden people have these overpriced cars. They were getting these loans for up to 125% of those values. They were okay for a few years there because they were able to actually sell these new cars for more. In a normal world, and I keep saying this because it hasn't been normal for like 3 years, but in a normal world, you would expect that the minute you drive off the car lot, your car starts depreciating in value to, on average, when you have had a car for 5 years, it's only worth about 40% of its original value. But that's always been the phrase, right? The minute you drive your new car off the lot, it's worth less. But we've been in bizarro world for the last 3 years. And the values in fact, my mother-in-law just sold her 2-year-old car for way more than she paid for it 2 years ago. And so because of that, people were in this cycle, but it's not something that can last forever. So looking at some of the numbers I wrote down, when it comes to loan defaults, the best state is Utah. 1 in 20 new car loans is in default. That's the best. Then we've got California. 1 in 12 car loans is in default. Texas, 1 in 10 car loans is in default. And then right here where I live, Washington, D.C., 1 in 4 car loans is in
Wow.
default right now. And a car loan only has to be in default about 90 days. So if you don't pay your car payment in 90 days. So it looks like repos are on the highest, mainly in the southeast part of the United States. So if you're in Georgia or South Carolina or Alabama, Florida, there's a lot of repos. The repo mans are very happy. So I'm predicting that this $1.5 trillion that's now loaned out, there's going to be something happening. You got to watch this space, but I think it's going to affect our stock prices. Things like Carvana and all of these new companies that became public in the last couple of years with their new selling model, as well as even the manufacturers. There's got to be, again, we're seeing the ripples. And in this particular case with the cars, I mean, the repos are way up across the country, but especially in the Southeast. And the ripples, it seems like the ripples are getting bigger than getting smaller.